Coming up today, Dow Jones closes above 40,000. Has a new rotation started? What sectors could rally next? PPI comes in above expectation. The latest from the commodity markets. And say hello to Vice President Kamala Trump. It's going to be a good one, guys. Let's go. Welcome back, Perma Bulls, to your favorite financial channel out there. My name's Jared. I'm going to get you up to date on financial markets this Friday, sharing with you all the most important news, data, charts, and memes to keep you informed and entertained on financial markets. And what a week we've had. Just witnessed some historic rotation out of mega cap tech back into small caps. S&P 500 still looking a little technically overbought here in the short term, getting some reversal signals. And it was a bit of a continuation of yesterday's pattern. Actually had mega cap tech as a group fall again today, with once again the Russell 2000 index leading the way, up almost 1.2%, breaking out to a fresh 52-week high. That's typically what you see in bull markets. Stocks and indices hitting 52-week highs, and we're getting some nice movement and market breadth as well. Looking at volume breadth, the amount of stocks above their 50-day moving average, and even the long-term 200-day moving average breaking out as well. Nice breakout in stocks making new 52-week highs, and especially on the Nasdaq as well. So, like I'd been saying, this market breadth is broadening out. It's coming back. Massive rotation out of the largest stocks that have been leading the market this year, and the volatility index still really low, which bodes well for forward returns as well. Also really helping out the pitchers, a sharp dive and short-dated bond yields. Look at that, the 2-year. Fallen again today to 4.45%. It's pretty much saying the Fed is going to cut in September. And the spread between the overnight Fed funds rate at 5.25 and the 2-year now, about 80 basis point gap, big divergence, and I'd back the bond market. And so it's looking almost certain now the Fed is going to cut rates in September, and that's what I think's caused a massive repricing in the market. Big institutional money and hedge funds to cover some shorts in small caps, trim their positions in those large caps, and like I said, this could be just the beginning of a month's, and who knows, maybe even a years-long rotation. Got short-dated Treasury bond ETFs breaking out today, and high-yield bonds as well, pressing up against that resistance. That's really bullish price action for risk-on markets. Helping the picture also is a pullback in the dollar, pressing down against multi-month lows. Also saw a really strong rip in clean energy today, up 4.3% on the ETF PBW, with some really strong signs of accumulation. These big fat green candles over the last couple of months. And it's kind of interesting because Trump's likely to get back in the White House, and he's not really pro-clean energy. However, the sector might be also responding to the prospect of lower rates, since it really got knocked down the last couple of years on the back of the Fed rate hiking. It's like a lot of clean energy products are big ticket purchases, consumers finance them, so this sector is very sensitive to interest rates, and that is looking like it's nearing an end of a stage 1 accumulation. Bit of a continuation in other yield sensitive sectors like home builders, regional banks creeping a little bit higher, and REITs breaking out fresh multi-month highs as well. Well, like I said, still a lot of mega cap tech looking a little technically overbought and exhausted. There's Apple, still trading near the top of the range. Microsoft's had a bit of a pullback. NVDA is still kind of hanging in there, but the price structure looks to have definitely changed. And same with a few others like Amazon and Meta as well. Also helping things out is the market's expectations of inflation continue to track down. We can see that in the spread of inflation-protected treasuries. And we've now got Fed Fund futures pricing in almost 95% chance Fed's going to cut in September. Like I said, looking at that price action in the 2-year government bond yield, market's pretty much saying it's a certainty. Jay's going to cut on the 18th of September. We'd have to get some really surprising prints coming before then for that not to be the case. I know the market's been pricing in cuts all year and had to push them out as we got a couple of hot CPI prints. We did have inflation tracking up for a little while there. Oil did get up to $90 a barrel. The administration did knock it over, and other components of inflation have come down. And so I'd say Jay Powell is just going to make sure the next couple of CPI, PCE prints are not too hot. Then I think he really can cut in September. And maybe in addition to that big repricing in short-dated bonds, we got that big rotation yesterday into small caps versus large caps, which we got a little bit of a continuation on here today. And that move yesterday, which we should all take notice of, was historic on a lot of measures. Often when markets change, they can change really swiftly. And just looking at that percentage daily change of the Russell 2000 index minus their Magnificent 7, that was an all-time record. Small caps outperformed the Mag 7 by 7.8% just yesterday alone. Just to put it into context, the size of that rotation. Another way to look at it is the Russell 2000 minus the S&P 500. Second highest spread on record. A 6 sigma move, that's 6 standard deviations, which if markets were truly random, that should only happen once every 500,000 days or so. However, the last time we saw it was 16 years ago in 2008, and that was down near the market low, and small caps went on to outperform large caps for a good couple of years after that, before the emergence of the mega cap tech really took hold come 2011, 2012, and they've pretty much been running the show since. Another measure at extremes is the 3-month correlation between the S&P 500 and the equal-weighted S&P 500, showing a huge dispersion in market breadth. Again, last time we saw this type of action and records was in the late 90s, when large tech stocks had significantly outperformed for years and years. In fact, for a good another 7 years, small caps and value stocks, commodity stocks, significantly outperformed large cap stocks and the Nasdaq as well. And just keep in mind in bull markets, the majority of gains come at the start and the end. What you're looking at here is a bar chart of the aggregate annualized returns by decile. That's dividing all the data up into 10. Looking at the 10 last S&P 500 bull markets since 1966, with the deciles defined by trading days in each bull market. So you can see in the first 10% of a bull market, the annualized returns at 74% are huge. So what that means is the early stages of a bull market, when we bounce off those lows, when fear is at a maximum, just like we saw in early 2009 and again in March 2020, that bounce back comes really sharp with high returns. Then it kind of drops off a bit, picks up towards the end of the bull market. Strangely enough, in the 9th decile, it drops down. But then in the last decile, the last 10% of the bull market, it can add on significant returns, like we saw in 99 and like we saw in 2020 going into 2021. So for sure, there is strong potential. We are in the late stage of a bull market. Who knows, maybe the secular bull market since 2009, which is 15 years old. However, looking back in history, some secular bull markets can go on for 20 or more years. So I think a lot of people would be surprised if this secular bull market ran through to 2030 or beyond. However, nobody really knows. That's why we follow the trends. But at the end of the day, anyone trying to time the entire market has got worse odds than gambling, and you're betting against the strongest long-term trend, and that's stocks significantly outperform every other asset class in the long term, including property, which isn't shown on this chart. And within the stock market, over the long term, small cap stocks deliver the highest returns over large caps. Just not every year, just not every decade. Even better again is small cap value stocks, the highest long-term returning factor out there, and they do especially well when they've been beaten down for many, many years. And when the earnings yield spread of small cap value versus large cap growth is near all-time highs, which it still is now. Going forward, small cap value returns 16.8% a year more than large cap growth. And just looking at another interesting stat, the Russell 2000 index climbs more than 3% in a day, like it did yesterday in this super low volatility environment. Looking back in history, we've got a pretty good sample size here of 158. So I'd say this data is statistically significant. 76% of the time, we're higher 52 weeks from now. So these are the odds bears are betting against. Not saying it's not possible, for sure. A quarter of the time, we won't be higher in 52 weeks from now. However, I prefer to invest with the wind at my back and not in my face, and so I like these odds as well. Who also likes these odds is one of the best fund managers of all time, billionaire Stanley Druckenmiller, who's looking like a genius now after just a few months ago. He sold a lot of his tech positions and opened up a very large position in Russell 2000 index call options. In fact, just looking at the data of his family office fund, which manages $4.3 billion, he's actually put a sizable 15% of his portfolio into Russell 2000 call option, which is a leveraged bet that small caps are going to outperform. And he still owns some tech, but he's coupling that with some utility stocks, energy resource stocks, and some other industrials, as he always carries a well-diversified portfolio. And this is how I've positioned my brand new trading account I just opened for my new stock pick service and $1 Million Challenge. Out of the 5 positions I hold, 4 of them are small caps. In fact, the only large cap's Palantir, which is up over 20% since I bought it. I've been running the portfolio for only a month. It's already up 5.9% in just a simple return. And in fact, a time-weighted return, it's up over 8%, already well out in front of the S&P 500. And a time-weighted return is a much better measure to look at returns to account for cash flows, since I'm buying $500 of a new stock every Monday. And members can see in the private area what the growth of the account in US dollars is every week, along with screenshots of all the trades from my account, and again, receiving the picks in your inbox every Sunday morning, the day before I make the trade, where I explain to you in plain, simple English what the stock is, why I like them, the numbers, and why it makes sense for my portfolio. And I've already decided on what stock pick number 6 is going to be that I'm sending out to members this Sunday morning, since we've got the strong prospect of the Fed about to cut rates. One sector that can significantly benefit from that is REITs, real estate, and we're already seeing some good market breadth. Along with financials, the percentage of stocks in those sectors at 63-day highs. That's 3-month highs, and REITs is 42%. Financials 44%. So we're already seeing some signs of good market breadth in those two sectors. And so the stock I'll be investing in this Monday is an exciting small cap REIT who is a leader in a new secular trend. It's a well-run business. It's undervalued according to my indicators, pays a healthy dividend yield of 6.5% and is uptrending on the chart as well. And so if you'd like to know what stock this is and get my latest report sent to your inbox this Sunday morning, along with following my new trading account in real time, then click the link below this video and head on over to my website, clickcapital.io, click on the red banner at the top and join my new weekly stock pick service before this 40% special offer I'm currently running expires this weekend on Sunday night. As this will be the only time I offer 40% off this service, the price is normally going to be $770 lifetime fee. However, once you hit the checkout, just apply coupon code STOCK40. That'll knock $308 off for you, and you'll only pay $462 one-time fee, no ongoing costs, and that only works out to be $46 a year, as my goal is to turn this new account into over $1 million in under 10 years, and then I'm going to invite all paid members for a special meetup and celebration in Las Vegas, which I'm very excited for, and so I'll be doing everything in my power to turn this new account to $1 million, and like I said, do it with 100% transparency, so you get all my picks and exit alerts on the day before I make them in my new trading account. So I invite you to jump on board and join this journey with us all. Just click the link below this video to sign up today and get instant access inside the private members area, so you can see all my current open picks and what the next one's going to be this Sunday morning. I'm sure you guys are really going to love it. Okay, diving back into the daily market review. And so like I said, I'll be buying a small cap REIT this coming Monday in my stock picks portfolio. As you guys know, I like to combine macro fundamentals and technicals all together to find really good opportunities out there. And so we've had a clear breakout in the real estate ETF. You can see here my trend strength. We're just going back to blue, showing the market's getting back to some momentum, put in some higher highs, higher lows today. And what's really caught my eye that I showed you guys yesterday was this trendline break, showing strong signs that we may have ended the stage 1 accumulation and could be in the early stages of a stage 2 advance, where all the money's made in markets, as REITs have been in a multi-year bear market because of higher rates, troubles in commercial real estate, changing of the market. However, that looks to have all be potentially being swallowed up pretty well by the system thanks to the help of the Fed. And now with the prospect of rates getting cut, coupled with this price action, I think could be potentially setting up a good macro opportunity here to get into REITs. And so I've looked within REITs to find what I think is the best opportunity, the stock that has the best fundamentals, the best valuation, coupled with the best stock price, technical price action. And I think I've found it, and I also like the fact that it pays over a 6% dividend yield. And so if rates are going to come down, dividend paying stocks could also benefit. They've been lagging behind a few years, and the gap between what you can earn in these dividend paying stocks and bonds will improve in favor of the stocks. Not to mention I like the diversification benefits of having a REIT in the portfolio, as right now we've got some tech, consumer, commodity and energy. So I'm always looking to fill the portfolio with uncorrelated assets. However, there's still a widespread narrative out there that tech stocks' brutal Thursday sell-off was a preview of more to come, as a lot of people had been arguing that big divergence in market breadth and mega cap tech means we're just on the cusp of the market rolling over and crashing, which I'm not saying isn't possible. However, just looking at the trends in the data, I would say it's unlikely right here and now. I'd say it's more likely we're seeing a rotation out of tech stocks on the back of the macro changes we're seeing as well in the bond market. And it's still possible this could be a new everything rally, even though we may get a bit of a rotation into small caps and other lagging sectors. It's very possible mega cap tech may just consolidate and grind for a few months before continuing higher as well. We have seen renewed optimism on one of the largest stocks in the market, mega cap tech Apple, as they're about to go into their new iPhone upgrade cycle, which is a pretty significant deal. Wall Street seems to be betting that they're getting in on this AI boom with their new IntelliPhones, and it does offer the potential for them to come back to growth, and that could help at least hold up mega cap tech going forward as well. But for some context, I thought it'd be interesting to run through some monthly charts of all the sectors out there to give you guys an idea of technically where we are, the trends, how overbought, oversold, and other price action we're getting with a bird's eye view of all the sectors. There's semiconductors, pretty hot, easy to argue. They're definitely overbought on the monthly chart here. There's the IPO sector, which has been creeping back this last year, but typically in bull market peaks, when things are really frothy, like we saw in 2021, and all other market peaks in history, you'll see the IPO market go crazy as private companies seek to cash in on that and go public. We're just not really seeing that super enthusiasm in the IPO market. There's a look at the tech sector, XLK, definitely quite stretched here on the monthly. Consumer discretionary has broken out a bit of a months-long consolidation. It's in an uptrend. Communications with companies like Meta, looking pretty stretched. Retail still consolidating. Consumer still offering mixed signals. I'm not in a rush to buy retail stocks here, especially if Trump gets back in. He's likely to slap more tariffs on China, which could increase the price of consumer retail products coming into America, along with discretionary stocks, so I'm not quite sure about them. Home builders definitely like lower rates, but they're already stretched here, and the residential housing market, in my opinion, is still really overvalued. So home builders could still hold up, however, I think there's still more risks in that sector. Industrial's looking good. consolidating near all-time highs. Financials, like I said, will be a beneficiary of lower rates, take the pressure off their books with all those bonds and unrealized losses. Price action's looking good, pressing against all-time highs, and like I showed you in that earlier chart, got good market breadth in financials and REITs. Energy still holding a good uptrend. I think this has got a good tailwind from a Trump presidency as well, along with oil and gas. Materials still holding up there, and like I said, gold miners and junior gold miners have the potential to put in a big rally over the coming years. Airline companies, can't really get excited by them. They're long-term underperformers and price action doesn't look good. Regional banks could be the surprise trade over the next 6 to 12 months. A lot of people have forgotten about them. With rates being lowered, they could really come back in a big way. A lot of good valuations and dividend yields to be held there. Aerospace and defense has been performing well underneath the Biden administration. Military industrial complex definitely liking the geopolitical moves we've had of late. However, we're looking a little bit stretched here, and under a Trump presidency, just like his first term, he prefers to negotiate and dial down the prospects of war, which he's indicated he wants to do with Ukraine. However, he will still keep America's military very strong, but I think this could be just due for a period of consolidation as well. Transport's consolidating. Biotech's an interesting one. Definitely one I've got my eye on, and I'll probably be adding a biotech or healthcare stock in the coming weeks to the Click Capital stock picks portfolio. It's been consolidating quite a lot, definitely got hurt by the rates. However, it too looks near the end of a stage 1 accumulation phase, and we could be about to break out into stage 2. Healthcare as well, pressing up against all-time highs. Staples looking good, consolidating, holding up, and utilities I still think have a lot of potential. Definitely with lower rates, a yielding sector, and the tailwind of the AI boom. I think utilities could also surprise going forward. Also looking good, microcap stocks, potentially looking to enter that stage 2 advance after consolidating for a couple of years. And small cap value, been going sideways for 3 years. I think has a lot of potential. And for reference, there's the Magnificent 7, putting in the 3rd consecutive reversal signal of mine. The last time we got that, almost nailed the top. Prior to that, it can indicate a pause in consolidation. However, I think it's more significant when the market's really stretched and has gone a bit vertical, like it has done this year. So like I said, I'm not calling for Magnificent 7 to crash. I think we could be in a period of consolidation, and they very well may continue to go on and rally more. I just like the price action better in small caps, not to mention the valuations and the macro tailwind of lower rates as well. Okay, so moving over to the macro, we got some wholesale inflation data coming today. A little bit hotter than expected, which we can see on the economic calendar. Economists expecting month over month to have grown 0.1%, came in 0.2%, and core PPI coming in a little hotter than expected as well. So like Jamie Dimon says, inflation and interest rates could stay higher for longer than we think. I'm definitely not ruling out that possibility either. I regularly talk about the risks to a resurgence in inflation, definitely still possible. However, I look to hedge away that risk and even take advantage of it by being exposed to some commodity stocks, as well as combining that with a good prospect that we could see lower rates, and so other stocks like REITs could benefit. So I like to try and play it from all angles, because at the end of the day, the trend in core CPI year-over-year change is definitely down. Last print coming in at 3.3%, and underneath the hood, contributions to US core CPI definitely trending down, even getting some disinflation readings out there. And looking at the percentage of US CPI components rising more than 0.2% month over month, actually took a dive in the latest data, showing that the breadth of inflation is turning down as well. I think this could be contributing to this big repricing we've seen out there across financial markets. On the other hand, the consumer still not feeling that great when they're doing these surveys. Consumer sentiment falling to an 8-month low and frustration with inflation. I do have one consumer brand stock in the portfolio that has been performing well. However, I'm in no rush to get huge exposure to the consumer here. Week after next, we'll get the Fed's preferred inflation gauge, personal consumption expenditures. I'd say that's due to come in line with expectations, maybe even a bit softer. We have got a lot of core components downtrending now. Still got oil, energy holding up, but actually finished the week down as the uptrend looks to have taken a bit of a breather. We don't really have geopolitics too much of a concern right here, and it looks to have rejected a bit off that $84 level. What's also likely to help the inflation picture just around the corner, we've got some key agricultural commodities pulling back significantly of late, including corn and wheat, which combined make up for over a third of the world's calories. These two commodities, corn and wheat, which actually broke down to a new multi-month low today. So that should bode well for food prices around the corner, and that's already showing up in the agricultural ETF DBA, been tracking sideways for a few months now, along with other key inputs into it like sugar and soybeans, quite weak as well. But like I said, just following the price action of probably the most informed market in the world, US Treasury bonds, very weak in the short end, trading down, while looking at the long end and 10-year yields and 30-year yields holding up a bit better, giving a bit of a steepening to the bond inverted yield curve and just a really sharp dive in the 2-year, and quite often the bond market will lead the Fed. Also helping financial markets is a little bit of recent strength in the Japanese yen. As I had been thinking a few days ago, looks like the Bank of Japan also intervened on top of the pullback in US bond yields, trying to close the gap between the currency and yields of the two major economies. And we can see that in the price action of dollar yen, getting back below its 50-day VWAP. And so that's a good sign for financial markets. We don't want to see the yen completely go down the toilet and cause some potential contagion. So hopefully that can continue stabilizing along with volatility coming down a bit as well. Like I said, US government bond yields helping to pull the dollar back, which is helping a lot. And I'd say it's also given a bit of a tailwind to gold, pressing up against all-time highs there. And it's more volatile, smaller brother of silver as well. Moving on to the latest from the US presidential race. Sure, a lot of you heard Biden's gaffes yesterday. Wasn't really able to answer questions on how his record government spending has driven inflation either, but his best one was referring to his Vice President Trump. And so someone cleverly on X created this AI image combining Kamala Harris and Donald Trump. Definitely an interesting looking person. But more and more people from his side of the fence are backing away, including major donors. I'd say if you polled people, over 80% of them, both from the left and the right, would probably say he's no longer fit for office, especially for not another 4.5 years. However, at the end of the day, the buck stops with him. Him or his wife really decide whether he's going to pull out or not. And as it stands now in betting markets, still got Harris just out in front, but pretty much neck and neck with Biden, who's really going to be taking on Trump come this November. But like I've been saying, if they are going to do a switcheroo, I would think that would be pretty soon. Maybe in the next week or two, as a bit of political cannibalism is currently taking place. A lot of Democrats want to push him out and shoot their shot with Harris. As always, I'll keep you guys updated on all the latest development from this year's most diabolical US presidential election race. Gone from banana republic stuff to almost parody at this point. We're just starting to get into the thick of Q2 earnings season. Heard from the big banks today, then getting into it next week. We'll hear from a few more, but the big one will be the week after next. We get into mega cap tech. Not too much action around bank earnings today. JP Morgan did come in with a slight beat. Market sold them off slightly. Similar deal to Citigroup. Did beat on expectations. Market sold them off a little bit. And Wells Fargo got hit quite hard, down 6% today. But even with that, the financial sector still managed to finish up as a group 0.33%. And just to let you guys know, I won't be doing the daily market review this coming Monday, as I'll be taking the day off. However, come back to the channel tomorrow. I've got a really interesting video for you guys called Chasing the Elusive White Unicorn Stock, a 100-bagger. I think you're going to find that really valuable, and this is something I'll be doing for my new stock pick service as well, which, like I said, my 40% sale is about to close this Sunday night. So if you're thinking about hopping on board, now's the time to do it. Don't miss out on this awesome opportunity to join this community on this exciting ride we've got ahead of us. Just click the link below this video. Head on over to my website, clickcapital.io, and follow instructions to join today. Other than that, I'll be back once more this week with a special weekend video tomorrow, and then I'll be back Tuesday night with a daily market review as per normal. Thanks very much for tuning in with me today, and I'll speak to you guys again soon. Cheers.